Hi, I'm George Pandaleon. I'm the president of Inland Institutional Capital Partners, which is part of the Inland Group of companies. The Inland Group is a sponsor of real estate investment programs. We've been in business since the 1960s. We have sponsored hundreds of real estate investment programs, primarily for individual investors. We now have, in the last 5 or 6 years, put together a pretty good sized portfolio of institutional investments, and we have about 25 billion of assets under management in total, of which approximately 4 billion, a little more than 4 billion, is in institutional programs for the benefit of institutional investors. Inland really has two investor bases, as I just mentioned. The biggest investor base for us is individual investors, but we also have about 20% of our business that's built on institutional investor interests. And right now, they're seeking similar goals. They all are seems to be focused on income, where in the past cycle there was a lot of expectation of future price appreciation, and people weren't quite as worried about getting a short-term dividend from the real estate. So that suits Inland quite well, because historically we've been very income oriented, and we tend to buy stable properties, primarily retail, although we also have lots of hotels, a reasonably large portfolio of office and industrial buildings as well. But we typically buy core quality, income-oriented property, and it feels good after several years in the wilderness to actually have people interested in what we do again. There has been a move by large institutional investors, primarily non-U.S. investors, but it seems like the domestic pension plans are going to be moving in this direction too. They're just a little slower, to de-emphasize traditional opportunistic real estate funds and move toward more of a direct investment model where they have a lot more control. The prototype for that might be a structure that we just put together with PGGM, the large Dutch pension plan, and one of our companies, where it's a 55-45 equity split. So the partners are essentially even up, and they have certain controls over what gets invested in that program or how that program is invested. And it allows them to stay very close to what's actually happening. And we see also more of a move toward, so there are two trends. One is moving toward what we call core income-oriented property and away from the big sort of future price appreciation of expectation. And then the second is this move toward control, because I think many of the investors in those commingled funds found that when the trouble came, they really didn't have good information. They couldn't really explain to their superiors what was happening and why these value losses were happening, and frankly they were embarrassed internally. And so there's this move to have more control and more clear information. There's a question as to how far that can go, because that's a much more time-consuming way to invest. And so in the long run, I think most of us believe that the funds will come back in maybe a different form with different structures and rules and reporting, but the fund structure is going to be important because these people have to leverage their limited resources of people. It hasn't really started yet, but we think once they become overwhelmed with all these direct relationships, they'll realize that there is value in the fund model, and it just needs to be restructured. We don't know what the new paradigm is going to be for a structure for a new fund, but right now we're finding a great deal of interest in direct investment with owner-operators who have significant capital invested alongside the institutional partner.